Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. It is Wednesday morning, and that means we bring on the legendary investor, Anna Kelly. Hi, Anna.
Hi, Michael. Great to be here today.
Nice to be here. Nice to be here with you. Always learn so much and have so much fun. I look forward to Wednesdays.
Me too, very much.
Awesome. Well, we have three important topics today. So again, folks, you're going to want to pay attention to these. It probably will go out at 9, 11, and 1 p.m. We don't mess around on this channel. Anna, the first one is, I just want people to realize that market crashes or corrections, bear markets, they are not fun. They are often very painful. And I'm a little afraid that some people may condition to they're all fast and sudden. I'm actually used to, bear markets that, kind of a death by 1,000 cuts. They take quarters, if not years to go through. And, they're more painful than just a sudden drop. Is that how you see it?
Usually there's at least signs of, bubbles, issues, for a while, and the markets get spooked a little bit, but they don't want to leave, because then they know it could be self-fulfilling prophecy. So they hang on, and you see some peaks and, troughs and peaks and troughs. And then they kind of slowly start to have some kind of external factor that puts them over the edge.
Yeah. I've gone back and researched bear markets over the last 3 or 4 months, and there are typically 2 triggers for bear markets. Again, these are always historically looking, so you can always look at the information and say they're a little biased, but two are. One is the onset of war, right? War, yes, generally speaking, is not a good thing for the stock market. People retreat, it's inflationary, it's just not good. And the second one is the Fed reverses a loosening cycle or an easing cycle and starts tightening.
And guess what? We're in both.
I was going to say, what do we got going on right now? Sounds like both of them.
Yeah. And I think yesterday the S&P was in correction, official correction territory.
Correct.
I've been doing a lot more research over the last several days on, what if Russia does attack Ukraine? What does that mean for us, right? And I learned some surprising things that I didn't realize before. I knew that war is always bad, right? Obviously, loss of human life and all of those things. But when we think about how does it impact markets, right? How do markets respond? Typically speaking, wars cost the U.S. a lot of money too, because we're supposed to be this defender of free countries, those that are freedom and democracy run. We want to come in and support them in some way. And so it becomes costly. The Fed already has a problem with trillions of dollars in debt, right? 7 trillion already net debt. And I think there's 40 trillion in future debt already promised that's just not due yet today, right? So one of the things I noticed about Ukraine, and I think this speaks to the stock market, so bear with me just a minute here, is that Russia is the #1 exporter of wheat. Ukraine is the #4 exporter of wheat. Ukraine is the #3 exporter of corn. And Russia is one of the top exporters of oil, not to the US, but to the whole, to the whole Eastern hemisphere. And so and petroleum, gas. So if they go to war and, allies of Ukraine say, we're going to do sanctions and we're going to cut off your supply lines to oil and gas prices go through the roof internationally, right? So there's a huge issue there. But the other thing that really surprised me, I had no idea. Exxon, BP, Shell, and JP Morgan Chase each have a 25% stake in Russian oil companies.
I did not know that.
Stake. Yes, I read that day before yesterday, I think.
Wow.
And so as soon as these sanctions go into place, it has a direct impact on a large percentage of the income of some of these big companies.
Sure.
But it also makes a big difference in our ability to bring in corn and wheat, et cetera.
Yeah.
So what does that do, Michael? It creates even more supply chain issues, more inflation. And so even if the Fed is going to raise rates, to drive down inflation, now we have a huge supply chain issue that those increases of rates may have to go up a lot more in order to bring those supply chain issues down. That is not good for the stock market.
No, I mean, there is a lot of talk because again, I've been talking about a 0.5 point move in March for quite a while. It's actually gone backwards. It was high as 99% after the hot PPI reading.
Yeah.
It's actually down to 62% as of this morning, or I guess last night. I'm assuming it's the same this morning, but last night. And that's because of what just happened, right? The whole idea that, maybe the Fed won't be as aggressive the first time because of this invasion. And I looked at it much like you. I'm like, are you kidding me? They have to come out now, because what's going to happen to oil and gas? And, I've researched the Ukraine. It's like the breadbasket of Europe, they called it. I'm like, that doesn't sound good. That's a bad thing, I think. So it's, inflation is going to be with us for a lot longer, and probably get worse before it gets better.
Yeah, it's, I'm trying to wrap my mind around it. I've kind of been writing out these scenarios, like what happens if this, and, where can the Fed go? And I think in some ways they think, well, maybe we can cool a little bit on lending, because lending isn't going to, already mortgage applications have dropped significantly in the last 2 weeks, significantly. Yeah. And so, they want to start raising rates, but if there's a huge supply chain issue that has nothing to do with rates, raising rates isn't going to control the consumer side, the demand side enough to counteract that, unless they raise them a lot more. So I'm not really sure why some of these are saying, oh, they need to be much softer and slower because of the war. I think because the supply chain issues are worse, they might have to get more aggressive with the rate hikes.
I agree.
I'm not an economist, they also don't want to push us into recession. And that's a real fear too. So if they go too high with rates, and we've got all these supply chain issues, there's many that are saying we go instant stagflation and deep recession. Yeah. So the Fed is in this real conundrum of, man, now we've added this to the other things we're dealing with. How do we keep the economy stable, not recessionary, not super high inflation, and certainly we don't want stagflation. And I just don't know what they do to respond to it, because I don't see any time in history, when I look in the past, that we had these things happening at exactly the same time.
Well, I've been saying this for a while, and I'll say it again. I think the Fed has they put themselves in a corner at this point where they have two bad options. There are no good options. They either hurt everyday citizens, which, pick a number, call it 90% of us, or they hurt the rich, 10%. Is it 80? Is it 20? Whatever it is. Those are the two options. By hurting the rich, they jack up rates faster than the market expects,
right?
Punishes stocks, punishes crypto, and could make the commercial market really, really dicey, right? The refis and all this bridge debt.
Right.
And it will stop transactions in the residential market, right? Because if 30-year goes from what now is 407 to 507, or heaven forbid 607, right? These are interest rates, transactions stop.
Yeah.
So, right, they either hurt the rich, or they pretend to be Bernanke and they try to talk a bunch, and they just do a quarter point for the next 7 meetings. That does nothing. That just keeps hurting everyday citizens. So I, for one, think
they can. I don't think they can. They're already behind the 8 ball.
Yes, so exactly.
I don't think they want to wait and see too much longer, right? And to the point about, the poor and the residential markets, they can allow things to get bad and then fix them, Band-Aid them, like they did during the pandemic, by saying, okay, guys, now we'll give you a 40-year mortgage. Now we'll lower your closing costs. We'll cover your closing costs with these programs. And so I think they still care about the poor, and they still care about housing affordability.
Yes.
So, they've got to raise rates, because rates don't just impact mortgages. Many people think, oh, these rates just impact mortgages, but it impacts the ability of businesses to borrow cheaply to continue to produce GDP. And that's really what the Fed wants to do. Because if we stop having high GDP and inflation and debt are higher than GDP, that's when economies really start to collapse. So they want to encourage big companies. It's not because they want to help the rich per se, but they're the companies that are producing. Yeah. And without production in the US, we go downhill. And I think they know that. So I don't think they want to go so aggressive that they hurt companies that already have huge debts on their balance sheets, right?
Yeah.
And most of it's adjustable rate debt, which we don't talk about. So, they borrowed at 3, And now
Yeah.
suddenly, if their loans adjust, like, okay, you might be at 5 or 6, that has a huge impact. So
Yeah.
what do they do to pay that debt? They start laying off people. They can't produce quite as much. And it's just not a good cycle. So,
Yeah.
but kind of back to your point about the stock market and, specifically,
Mm-hmm.
big money understands these things. And so they're getting really nervous. And so they're starting to sell, and that's starting to drop the markets. There's a guy I read and I saved it, and I'm sorry, I can't remember right now his name, but he's been investing for decades, and he's been studying the last big, recessions and which ones were long lasting and painful.
Mm-hmm.
And he said the patterns of the stock market, to your point, that it doesn't just happen in a day. It's kind of over a couple of years. The patterns that the stock market is showing right now are indicative and like no other than the Great Depression and the crash of 2000. And he said, these signs are telling us this one may be the one, and it may be really bad. Yeah. And you add in the war, and he's worried that he's like, move to safety, move to safety, move to safety. And he's like a multi-billion-dollar, investor. Buffett, Dalio, they've all said, expect the stock market. We're in an everything bubble. We don't know when, but everything's going to come down, right? Wells Fargo predicted a 0% stock market over 10 years. That was at the end of last year.
I saw that.
So these guys that are pretty smart and studied in the stock market, more than I am, because I've been all out and in real estate for a long time. I own one stock today, one, because I know I can have better control and understanding of my own real estate. So I've chosen to be mostly out. So I'm not too worried about it. But these guys have been in it day in, day out for decades. They're the ones saying, guys, quit dealing with the hopium. You need to move to safety. Things are about to correct and about to change. And that tells me it probably is. Plus all these other things we see. I don't want to be in the stock market right now.
No. I think, again, I see very similarities. And again, it's funny you talk about a 0% for the decade. 1970s, I talk about it. I did that 50-year research. We've looked at it. I added the S&P. It went up 1 point in a decade. 1 point.
I'd love to see that data.
Yeah,
you were brilliant. I love that you go back and add this stuff. And every 5 years that you did and you shared with the audience, that shows you, all this talk about affordability isn't really, really true.
Yes.
Now, I understand the last 6 months has been a skyrocket from that, right? But our wages are also going up.
Exactly.
But it's interesting. I did not know that during that short period. And, another to that point, if that was 1% over a decade, that was 70s to 80s.
70 to 79.
Okay. I remember, and I'm getting older, but I remember certain things, right? Back in about 98, when I worked for Bank of America in private bank, we were given all of the training and education on why do you tell your clients to invest with us and what the returns are. And they told us average 8. But I remember there being big peaks and big drops and big peaks and big drops. So they say, if you just stay in, it kind of averages 8, but nobody ever just really stays in, right?
Nope.
But what's interesting is you have these few years, and the late 2000s were really good to us, but people are short-sighted. And I think that's just the, go US, we're always going to keep getting better. So it's always going to keep getting better. And the reality is, Ray Dalio, I was listening to him some more last week, and I was listening to an interview, and people said, okay, Ray, what should people really expect over the next decade, 2 decades to make in a well-blended, diversified portfolio?
Sure.
And he said, you're not going to like my answer. He said 3 to 4%.
Oh,
you can make 3 to 4% in the market. And these are the people that know what we're doing. You're doing well. Because if you're all in large cap, all in small cap, all in growth, all in international, it's a crapshoot. One may do really well, one may not. But he said, in order to have a balance where you're controlling income and growth and preservation, and he didn't use those words, but I know that that's what he means. He said, don't expect more than 3 to 4%. Well, guys, on a 3 to 4% after taxes on the capital gain, you're not doing much better than just investing in a 10-year T-bill for 2%, right? So why would I want to be in the market when the biggest names in the market are saying, expect 3 to 4%,
Mhm.
even with high real estate prices. And even with today's higher rates that are 3/4 of a point higher than they were a couple of weeks ago,
Mhm.
I'm at least making a 6 to 8% cash on cash, and I get tax benefits. I can defer that gain forever. I've got mortgage pay down. I have appreciation. I will probably, and again, I'm negative on the stock market, I'll admit it.
Mhm.
But knowing what I know coming out of private banking, working with the top, probably 1% of wealth in the country at AIG with hedge funds for 20 years, I will never go back into that because I'm doing much, much better with much less risk,
Absolutely.
buying one rental at a time and staying in real estate. And that's why I'm so excited about real estate, Michael,
Yeah.
because I've seen names that you would know. I can't say, but
Sure.
big companies that you would know, their whole family giving us $100 million in premium to invest in hedge funds that have made 40% in a year and they lost all of it the next year, right?
Yeah.
I've seen big wins and big losses. And I, as a small guy, small gal, I've created that accredited investor status. I've created that net worth slowly but surely, sleeping well at night, knowing that I'm preserving capital while creating income, while creating net worth. And I don't have to worry about the stock market and inflation. I mean, yes, we worry about inflation, but inflation like killing the market and consumer sentiment running for the hills and crashing my investment and wars. I can just hedge it much better in real estate. So, I could preach to the choir all day long on this, but, if you're in real estate right now, you really might want to think about taking some of that money out now. This is the time to get in real estate. Don't let people tell you you've missed the boat. Rates are going up and prices are high. You haven't missed the boat. If you dollar cost average in the stock market, dollar cost average in real estate.
Absolutely. One rental at a time works. All you got to do is understand average for whatever your market, your buy box is, and just do good at great deals. It's hard. It's not easy. It's not supposed to be. But it is out there for you. So Anna, how can people find you?
Great. Every Wednesday here and on my special playlist on One Rental at a Time.
Yes.
You can find me on Facebook, LinkedIn, and Instagram, Anna Kelly, REI. And you can find me at reimom.com. If you're an accredited investor and you want to invest in large multifamily properties that make a difference in the community, you can find me at greaterpurposecapital.com.
Awesome. Thanks, Anna.